Philip Bilden, Managing Director of HarbourVest Partners in Hong Kong. You've been setting out the scene here at Super Return Asia. In your speech, you were showing how over the past couple of years the liquidity has dried up due to the financial crisis. So are things picking up again?
Yes, 2010 is moderately up on most indicators compared to 2009. But you must keep in perspective 2009 for our industry was one of the absolute worst on record following a global financial crisis and a leveraged-led crisis which had a huge impact on the buyout operators throughout Asia Pacific, particularly in developed Asian markets like Australia, Japan, Korea. Less affected were the developing Asia private equity markets, China and India, which seemed somewhat detached from what was happening and had a tremendous amount of capital accumulation, deal activity, fundraising activity, and IPO and M&A liquidity activity in 08 and 09. But into 2010, we're seeing improved signs. Deals are getting done at a higher degree than they were in 2009. And there's just more liquidity in the system. Valuations are higher. And when valuations are higher, people feel a little bit more comfortable about taking on risk.
But from the graphs that you showed during your session, it seems as though there's not going to be a major spurt of growth.
I would caution any institutional limited partner who is investing into the region to temper their expectations. There's a great deal of unrealistic, I would say, investor belief or euphoria in China and India markets. And not to take anything away from very real macroeconomic growth fundamentals in those markets. For private equity investors, however, there are many structural issues that come into play in terms of weighing up the risk and return in even very high growth markets. So, but having said that, this is one of the few places in the world where there is growth. In other markets, like Australia, which has a very strong economic link to growth through its resource-based sector and a very healthy economy with strong economic ties to China and India, it's also a very attractive place to be. But we're seeing in 2010 increased investment and increased liquidity. Again, after 2009, that was not particularly representative of its run rate.
So on the whole, would you expect PE firms to continue to focus on China and India, but capital flows to be somewhat restricted?
There's going to be even more general partners in this industry who want to either expand their activity or who want to set up their own funds. There will be even more limited partners, the suppliers of capital, the pension funds, the endowments, the financial institutions that capitalize these private equity vehicles, such that a general partner can go out and invest. There has been a huge growth in both areas, the general partner side and the limited partner side. In China specifically, we calculate that there's roughly $50 billion of investable capital currently. That should take maybe 3 or 4 years to invest, and yet despite that capital overhang, the market interest in all things Chinese will mean there's going to be more capital on top of that. So that's a risk. And navigating that amount of capital into the market will require some dexterity. Having said that, China is a very large market, and so it's going to be up to the GP community, the general partner community, to price in risk, to be disciplined, and to find situations where growth opportunities can be wedded up with growth capital and interests can be aligned between the owners of that business and the shareholders and funders of that business.
So are you optimistic about the short to medium term?
Yes, I am. If you had asked me this question 10 years ago about China private equity, where we had exposure, I would say it's an unproven story. If you'd asked me 5 years ago, I'd say it's still unproven, but we're feeling better. If you asked me today, I'd say that we've seen enough data, we've seen enough hard cash-on-cash returns in these investments to merit being actively invested in the China private equity market. Having said that, I think for most limited partners, trying to access those funds is going to be a huge challenge. So, fund of funds, frankly, is probably the most intelligent way for them to proceed.
Philip Bilden of HarbourVest Partners, thanks for joining us.
Stuart, thank you very much. Pleasure.